Hey everyone, welcome back. I am so excited to be your guide through this explainer on FAR210 Topic 3 Part E. You know, we spend so much time in accounting learning how to record all the shiny new things we buy, but today we're going to learn exactly how to say goodbye to our assets. Think of this as the final chapter in an asset's life story within our books. So grab your favorite pastel highlighters, pull up those beautifully color-coded notes of yours, and let's make this accounting topic easy, fun, and totally understandable.
Picture this. We have a cute little delivery truck that has served our business for years. It's been through rain, sunshine, and countless deliveries to our favorite customers. But one day, its engine finally gives out. Or maybe we just decide it's time to upgrade and sell it to someone else. The big question is, how do we officially remove its story from our financial statements? We can't just cross it out with a pen, right? There are rules for this, and that is exactly what we are mastering today.
Here's our lesson plan for today's class. 1. What is derecognition? 2. How to derecognize PPE. 3. Example, selling an asset. 4. Example, writing off assets. And 5. Disclosures and exam tips. Let's start with Section 1. What is derecognition?
Let's dive right into what this fancy accounting word actually means. In super simple terms, derecognition is the ultimate accounting farewell. It's the formal process of taking an item of property, plant, and equipment, or PPE, completely out of our company's accounting records. According to the MFRS 116 standard, this happens in one of two ways. First, on disposal. This is the happy ending where we sell the asset to a buyer and actually get some cash for it. Or second, it happens when absolutely no future economic benefits are expected from its use or disposal. That's the sad ending, where the asset is completely broken, beyond repair, and we just have to scrap it.
Moving on to Section 2. How to derecognize PPE.
So, the absolutely crucial point here is knowing how to actually do this in the books without totally messing up our balancing figures. Whenever you face a derecognition question, you just follow these 3 golden rules in exact order. Think of this as your foolproof exam checklist. First, you've got to zero out the original cost. Because the asset is an active account with a debit balance, we do the complete opposite. We credit the asset account to remove it. Second, we have to clear out all the depreciation it has gathered over its useful life. Since accumulated depreciation is a credit balance, we debit it to make it disappear. And third, we record whatever cash we got in the bank and figure out whether we made a profit or took a loss on this whole farewell.
Take a look at how beautifully this all balances out. It's like a giant puzzle. Your debits are the accumulated depreciation you're wiping out, plus the cash you're receiving. Your credit is the original cost of the asset you're removing. But what about the difference? Well, if our carrying amount, which is what the asset is currently worth in our books, is greater than the cash we receive, we are losing out, so we debit a loss on disposal as an expense. But if we get lucky and receive more cash than the carrying amount, we credit a gain or profit on disposal as income. It's the perfect balancing act.
Now for Section 3. Example, selling an asset.
Let's put this into practice and see how it shows up in a real exam situation. Back in a November 2019 test, there was a scenario where a company called TBBH decides to sell an old motor vehicle to Gary Ltd. for 58,000 ringgit. The very first thing the examiner wants to test is your theory. Does it meet the criteria? Absolutely. Because TBBH sold the motor vehicle to a third party, the MFRS 116 criteria are perfectly met and the company can officially derecognize the motor vehicle from its accounts.
But listen closely, because here is a massive trap where so many diploma students lose marks. You cannot, I repeat, cannot, just use the depreciation from last year. You must calculate the exact accumulated depreciation right up to the specific date of disposal, which in this story is the 2nd of May 2019. This means patiently calculating the depreciation for those final 10 months. Our workings here show the accumulated depreciation totals 13,125. When we take our original cost of 75,000 and subtract that exact depreciation, we get a net carrying amount of 61,875. Since Gary Limited only paid us 58,000, our carrying amount is higher than our proceeds, which leaves us with a loss on disposal of 3,875. Always do these workings clearly on the side before you even touch your journal entries.
And here is where the magic of our golden checklist really shines. When we plug our carefully calculated numbers straight into our journal entry, everything aligns perfectly. We debit the accumulated depreciation for 13,125. We debit the bank with the 58,000 we got from Gary, we debit our calculated loss of 3,875, and finally, we credit the original cost of the motor vehicle, which was 75,000.
Add up all those debits, and they perfectly match your $75,000 credit, neatly and permanently removing the vehicle from TBBHD's books. Done and dusted.
Moving right along to Section 4. Example, writing off assets.
Okay, so selling to a buyer is the happy ending. But what happens if our poor asset doesn't find a buyer like Gary Limited, and it just suddenly dies right there on the factory floor? The main difference here is the massive plot twist at the end. In a normal disposal, we sell it, cash flows into our bank, and it cushions the blow of losing the asset. But in a write-off, the asset is broken, destroyed, obsolete. There's absolutely zero cash coming in. And because we get nothing in return, the entire remaining net carrying amount of that asset instantly becomes a massive loss for the company.
MFRS 116 is super clear about this. For items of property, plant, and equipment that are scrapped, meaning absolutely no future economic benefits are expected, the items have to be removed from the books. And importantly, that remaining net carrying amount at the date of derecognition is recognized instantly as an expense in the statement of profit or loss.
Let's look at another exam story. I call this one The Tragedy of the Broken Drying Machine from the June 2019 exam. It was purchased way back in January 2011 for 85,000 ringgit, but in September 2018, it broke down completely, beyond repair. Management had no choice but to scrap it and write it off. Now, if you get a question like this, do not panic. You apply the exact same logic. You have to patiently count your months from January 2011 all the way up to September 2018 to find your total accumulated depreciation. Only once you have that can you figure out the remaining net carrying amount, which will then become your total write-off loss for the year. Remember, no bank debits here, just pure, unadulterated expense.
Finally, Section 5. Disclosures and exam tips.
We've conquered the hard math, calculated the exact months, and balanced our journal entries. So now let's scoop up those easy theory marks. At the end of an exam question, examiners love to ask about notes to the accounts. You can really impress them by knowing that beyond the strict mandatory rules, companies are highly encouraged to voluntarily disclose some really interesting details. For example, they should disclose the carrying amount of temporarily idle PPE. Assets just sitting around doing nothing. Or, my personal favorite, the gross carrying amount of fully depreciated PPE that is stubbornly still being used by the business. It's like that old faithful office printer that has zero book value, but still prints beautifully every single day. Mentioning these voluntary disclosures shows you truly deeply understand the standard.
Okay, I know accounting can feel super overwhelming sometimes. There's so many dates, calculations, and little rules to remember. So right now, I want you to just pause, drop your shoulders, and take a deep breath. You are learning complex financial reporting, and you are doing an absolutely amazing job. Take a little break, enjoy a sip of coffee, and let all these concepts settle in your mind.
Because guess what? You have officially mastered the asset's farewell journey. You now know exactly how to remove an asset, clear out its depreciation, calculate the profit or loss, and record the perfect journal entry. You are more than ready to tackle these concepts in your tests and assessments.
I truly believe you are. To get totally prepared, make sure you review your straight line and reducing balance formulas, keep practicing those journal entry T accounts until you can do them in your sleep, and always double-check your disposal dates. Keep up the brilliant work, stay positive, and I will see you in our next explainer.